Last week in the S&P 500, we had some mixed results right across the board, although the thing that will pop out on the screen is that Nvidia was down around 8%. No surprises given the fact there was that widely anticipated earnings. Now they did in fact report a beat, as we can see, for the fiscal second quarter, but the expectations are very high, and in fact analysts do say that Nvidia would have to have a massive blowout of both their earnings per share, their revenue, as well as their guidance to see an incredible increase on top of what has already been more than a 150% increase just in 2024. Now looking to the week ahead, we do see a cool down now from earnings season, although we do want to point out that Broadcom will be reporting their earnings after the market close on Thursday, so definitely something to keep an eye on. And interestingly, when we did take a look just a week ago in the Fear and Greed Index, we were sitting in the neutral, which in fact was sitting at fear just a few days before. In fact, what we can see, a month ago the market was in fear, a week ago it has moved into neutral, and now for the close of the week we are sitting at greed. Very interesting to know how quickly the tides can turn, both moving towards greed, extreme greed. And finally, before we look at these stocks in today's episode, we also want to remind you that from the latest Fed minutes, there is a very likely rate cut that is going to happen this month, something that will be very interesting to see how the market plays out. Will this take shares higher? Will we see the equities pull back? And something we will be analyzing very closely on this channel. And for those that want to know when that is, September the 17th to 18th is when we will get those meeting minutes, as well as understanding the implications for the rate cuts. Are we going to see the 25 basis points? Is it going to be 50? Or in fact, will it completely take the market by storm? And will we see absolutely no decreases to that interest rate? Now in today's episode, what we want to focus on are 6 undervalued dividend stocks that we deem to be a buy for the month of September. As always, we're going to talk about the historical performance of each one. We are going to get into essentially some of the underlying metrics, like the free cash flow, like the growth. And as always, we are going to run each one through our valuation model, getting to our own intrinsic value, what the margin of safety we deem for each one of these to be appropriate, as well as the massive upsides that we do see for some of these stocks from Wall Street and their targets for 1 year out. So let's jump into the first undervalued stock today. It is Salesforce. Now straight off the bat, we see a very rare strong buy from Quant. We also get a buy from Seeking Alpha and a buy from Wall Street, and this software company currently sits in the midpoint of the 52-week range. We also note it does have a yield, although fairly trivial, at 0.63%, and currently the forward PE does sit around 25. Just for those that are interested, S&P right now sits around the 23 mark. And we see over the last 12 months, it is up around 18%. Over the last 10 years, significant outperformance of the S&P, up around 324%. And we can see all-time highs sitting around the $320 mark in 2024. Now, what we also like to do with each one of these stocks is see how they performed in the latest earnings, as well as expectation moving forwards. And very nice to report, for CRM, they have beaten analyst targets over the last 4 quarters. 100% track record, very nice beat as well just in the more recent period, and over the next 2 quarters they are anticipating double-digit growth to the EPS, and if they are able to maintain that record of beating analyst targets, then we will in fact note for the January 2026 that EPS will bring the forward P to around 22.7, in fact even lower if they do maintain that streak. Now as we said, we do want to run through each one of these metrics. Now typically we do look at dividend safety. Given Salesforce have just recently started to apply a dividend, we don't have a score. That is something we will keep our eye on moving forwards. So then let's jump straight into the metrics. So the first metric we want to draw attention to is the free cash flow payout. Remember, for all of these companies, we will tend to ignore the earnings data. It is susceptible to manipulation by management through accounting. So free cash flow payout, 7% on a trailing 12-month basis, 13 over the next 12 months. As always on this channel, we want to see below 60% to give us faith management can offer us double-digit increases that we love to see. For Salesforce, well below 60%. Granted, they have just started to pay dividends, but the anticipation from shareholders are very nice increases moving forwards. Free cash flow, this is a very strong company in terms of this metric. As always, we want consistent increases moving forwards. That is what we see. In fact, 1.22 in 2015, 9.75 in 2024, so rapid increases. And the great news for shareholders, that is expected to continue moving forwards, $12.60 over the next 12 months. We then move on to the sales growth, where we always want to see the higher the better. double-digit growth is typically what we get from these type of companies, and we note whilst it has been slowing down, even in the more recent year, in 2024, 11% does look very good, very healthy, but just something to bear in mind and something we can factor into our margin of safety, whether or not this company that did have some very good growth over the last 10 years will be able to maintain it at that rate, or if in fact we will start to see this slow down moving forward. So from a numerical perspective then, the total sales has increased from 5.4 billion in 2015 to around 35 in that more recent year, so nearly 7 times growth to their top line. And shares outstanding, whilst they did outperform the S&P over the last 10 years, so this isn't a major concern, we can see they would have diluted your position over the longer term, issuing shares 624 to 980 just in that more recent quarter. Then ROIC, very important metric, if not one of our favorite ones to highlight on this channel. It does give us faith that management are able to effectively allocate their capital. Now we want to see 10% or more just to have that faith. Now they have hit that on the trailing 12 month, but do understand over the last 10 years it has been a lot lower than what we do require. So hopefully moving forward we can see a base of around the double-digit rate. Then we get to the operating margin and free cash flow. So if we start on the left side, for this we want to see around 16% or more. Again, over the last 10 years it has left a lot to be desired. 2024 though, it does look to be above that minimum level we want to see and increasing on a trailing 12 month. So definitely one to keep an eye on. Margins are very important when you do analyze companies. You don't just want to see increases to revenue, but you also want to see increases to the margins to give you that faith that these are very strong, high quality companies with wide moats that also show us some operating efficiency. Free cash flow margin as well looking very good. Minimum 5% is what we want to see, and we get well above that every single year. In fact, 28% in the more recent one, 32% on a trailing 12-month basis. Then we finally get to the net debt to EBITDA, a very important metric. Again, like the ROIC, one of our favorites to analyze. EBITDA referring to the earnings before the interest, tax, depreciation, amortization. We here want to see below 1.5. In fact, what this tells us are the number of years it would take the company to pay off all of their debt net of cash on hand. And why it's important, why it's a focus, it correlates to balance sheet strength as well as dividend safety. And look at that, in 2024, 0, over the next 12 months, 0. This tells us that it wouldn't even take Salesforce one day to pay off all of their debt net of cash on hand. So if they did have a dividend safety score, we would deem it to be very safe. And as we just mentioned, that balance sheet is very secure based on that 0 number. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value for today's episode of CRM comes to $318, and how we got that? Well, we ran it through the DCF model. As we can see, free cash flow year on year, it has been growing at 31% every year over the last 10, so very, very strong. But what we've gone for today are 3 different rates moving forwards, low, medium and high. Now we've gone for the medium at 10%, as we can see here, and with the discount rate we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, and as we see here, 318. Now this indicates to us around 26% upside, but as always you may believe that is too high, so just for transparency we will show you that 8% rate will indicate to us $275 intrinsic value, which means a 9% upside. For those that believe that is too low, well at the 12%, as we can see here, 366, giving us 45%. Now as always, these numbers are subjective, so you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Salesforce or any others that you're interested in. So let's take the medium rate, as we said, through to the next slide, and what we in fact have here then in today's episode is that intrinsic value, and we always apply, as we said, a margin of safety. We use 10% if it hits our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Now, if you believe that in today's episode we'll buy at $286, then we keep going till it's near the current trading price. And in today's episode, what we can in fact see on CRM, a high quality company, you are getting that 20% MOS with $305 as the price target from Wall Street, so they see 21% upside. As always though, do give us your thoughts whether or not you in fact do like these companies, whether you've been buying or maybe they are now on your watch list. Just to let you know as well, we have released our latest free weekly article. They drop every single Monday and you can read them completely free, instant access as well. And in fact tomorrow we are releasing our latest spreadsheet for the month of September, where we have a list of 25 undervalued stocks. We run through every single one, we look at a lot of information do make sure in fact you are signed up so that by tomorrow you will be getting a copy delivered straight to your inbox. The next stock for undervaluation in the month of September, we have Dollar General. Now this has been punished and in fact does sit at its 52-week low due to some very poor earnings that they announced last week. However, we do believe this is some severe market overreaction, and as we go through our analysis, we do believe this is one for some strong consideration. Now, over the last year, as we mentioned, it is down around 47%. Over the last 10 years, it is up around 32%, and we can see all-time highs sitting around the $260 mark. Right now, it is sitting quite some way away. Now, we also get a double buy rating from Seeking Alpha and Wall Street with a hold from Quant, and this one now trades at a forward P of around 14 and a forward yield of just under 3%. Now, in terms of their earnings, how they performed, well, in fact, we do know a 75% track record. They did beat the 3 earnings before the more recent one last week, where they missed by around 9 cents. And over the next 2 quarters, they are anticipating double-digit decreases to the earnings per share year on year. As we can see, quarter 1 and quarter 2, we get the mid to high single-digit increase. But if they do continue with that EPS growth over the next few years, the forward P will come down to around 12.22. So let's look at the actual metrics. Firstly, the dividend safety score sits at 60, borderline safe, so we can touch upon the reasons for this, and we are still waiting on their more recent increase. Now, what does a 60 score mean? Now, firstly, this was reaffirmed just a couple of months ago, and the definition of this is that the rating suggests a moderate risk of a dividend cut over a full economic cycle. Now, in terms of the last recession, so the Great Recession 07-09, how did they perform? Well, they actually cut the dividend, and in fact, they had plus 3.5% recession sales, which was well above the average of the S&P. Remember, that does sit around negative 12. Now, as we mentioned, we are waiting for their more recent increase, but over the last 5 years, as well as the last 20 years, they have increased those dividends at a double-digit rate, which is something we really like to see as dividend growth investors. And in fact, they have increased those dividends for the last 8 consecutive years. So dividend yield theory, something that we are talking about for the first time today, something we use a lot on this channel, and it does tell us that a company is undervalued when the current yield sits above the 5-year average. So a massive undervaluation signal, 2.84 above the 0.86% 5-year rolling, and on the forward P, 13.5, a lot lower than the 5-year, so again, a double undervaluation signal. In fact, for today's episode of DG, we do get a triple undervaluation signal. Consumer staples sector as a whole does sit much higher at 18.2. Now, do remember, we don't look at any one of these models in isolation, and we will conclude when we get to our valuation. So the free cash flow payout, whilst we want to see below 60%, we have below 40 for industry specific, and in fact, over the last 10 years, the majority of them, they have been below. However, in 2024, it was very high at 75. Over the next 12 months, though, nice to note, it is coming down to around 47%. And as we go through this today, you could argue this could potentially be a value play, one that the market has hammered and very, very harshly. Now, in terms of the free cash flow per share, it hasn't had that growth over the longer term, the consistency that we like or that we have seen from Salesforce. But what we do note from the lows of 2023, it has increased over the last year and is anticipated to nearly double over the next 12 months to around $5.04. Then we get to the sales growth. Now, we want to see for the more mature companies around 3 to 7% at a bare minimum. Remember that 3 to 4% is just to keep up in line with inflation. And whilst we see very good numbers over the last 10 years for the industry, we do in fact note in 2024 at 2%, that is lower than what we want to see. But when we do zoom out from a numerical perspective, we can in fact see that they have pretty much doubled their top line over the last 10 years. And what's also nice to note is they have returned excess cash to shareholder pockets through those share buybacks, reducing it from 306 to around 220. And if you also incorporate that dividend growth, that is very nice in terms of a combination for shareholders. But ultimately, we do want to see that share price increase as well, something we haven't seen, especially over the last year. But again, remember, if you are someone that is new to the company and there is value there, now may be the time to consider. ROIC then above 17% for this industry as a whole, and whilst we get it straddling around that for the majority of the last 10 years, it has been decreasing from 2021, 9% in 2024. So again, these are things to consider, especially when you look at the margin of safety in determining what percentage you do believe to be appropriate. Now, in terms of margins operating first, it does straddle around the 10% year on year. However, the more recent year, we do see that margin drop down to around 6%, something that we would say to keep an eye on and something we will cover on when we do look at their next annual report. In terms of free cash flow margin, again, straddling around that minimum we want to see, but the last 2 years haven't been great. The positive to take here is on a trailing 12-month basis, it has increased to around 4%, something that we are hopeful will be able to move more towards that 6% level over the next few years. In terms of net debt to EBITDA, then this is one of the reasons, or if not the main reason, why we did see that borderline safe score. We want below 3. Now, from the lows of 2021, it has started to increase. It is now above that, anticipating a small increase over the next 12 months, but it isn't too far above that we would consider this a red flag indicator. But again, like some of the metrics here, just something to keep an eye on, and it does become obvious why this company has been hammered over the last few years. Now, in terms of the valuation, first thing that we will point out is that our intrinsic value of 115 isn't dissimilar from Wall Street's target over the next year of 112, where they do see some very large upside of 35%. Bear in mind, you are also getting a fairly healthy yield of just under 3%. In terms of the margin of safety, then at the 10% level, well, it is a buy up to $103, at the 15% around 98, and as we said, we keep going till it's near the current trading price, and in today's episode, you are pretty much getting around a 25 to 30% mark, not at the 30 just yet, and for those at the 25% up to $86 does look to be a buy, but remember, there are some things with this company that maybe you do believe deserve a larger margin of safety, or in fact maybe a 25% at a minimum is sufficient. As always though, do let us know. We can do a deeper dive looking into their earnings report and doing the usual deep dive analysis that we do on this channel. The next stock that we're looking at is Microsoft. Now we get a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. This one is trading in the mid to upper end of the 52-week range and has come down from its all-time highs around $468 this year. It currently has a yield of 0.72% and a forward PE just below 32, but as always, whilst that may be high in relation to the S&P, you could argue a high-quality company like Microsoft, if not one of the highest quality in the S&P, does deserve to be trading at that premium. Over the last year, well, up 27%. Over the last 10 years, a massive outperformance of the S&P, up 809. Then when we look at their earnings, well, a beat. So 4 out of 4, very nice to note. No surprises with this company. Over the next quarter, very low increase to the EPS, but moving forwards, the consecutive 3 anticipating double-digit growth. And if they hit that June 2026 EPS estimate, the forward P will come down to around 27.23. No surprise then, dividend safety score sits at 99, very safe, one of the best balance sheets globally. And we do notice a nice double-digit increase in September. Again, nothing to be surprising from this company. It is something we see on a very consistent basis. And in terms of the last recession, well, they maintained the dividend. They had average growth of -8%, but they did marginally outperform the S&P, -48%, with the S&P 500 -55. As we mentioned, something very typical with this company, double-digit increases to the dividend year on year. And in fact, we should be expecting an increase this month as well. And double-digit is something that we would be very surprised if we don't get. And we can in fact see 14 years where they have been increasing those dividends on a consecutive basis. Now, in terms of dividend yield theory, what we do notice here is a reasonable / slight overvaluation based on yield theory. And in terms of the forward P, however, it isn't dissimilar, 31.9 versus the 5-year of 31.2. And we do in fact note the information technology as a whole does sit much lower at 24.2. But remember, when we do break it down, there are a lot of poor quality companies sitting within this sector. And as we mentioned, Microsoft does deserve a premium. But as always, the question is, how much of a premium does a company like Microsoft truly deserve? We then move on to the free cash flow payout. We're consistently below 60%, in fact decreasing 30 and 24, 29 over the next 12 months. So again, we are pretty much expecting a double-digit increase over the next few weeks. Free cash flow as well, looking very nice, growing as well, very strong, around 3 times over the last 10 years, anticipated to continue that upward trend over the next 12 months. And when we get to sales growth, well, looking very healthy as well, double digit for the majority of the last 10 years, 16% in 2024. And when we do zoom out and look at it from a numerical perspective, well, as we can clearly see here, more than double over the last 10 years. Now, they also do share buybacks, as is noted from this graph, although not very consistent. And in fact, over the last couple of years, the shares outstanding has remained constant. So maybe something to watch out for if we do get not just a dividend increase, but also a share buyback program. ROIC looking very, very strong. Again, this shouldn't be surprising for a company of this caliber, 30% in 2024. And the margin, something we did talk about earlier in the episode today, operating efficiency, not just increasing their top line, but margin going from 30 to 45%, as well as the free cash flow margin looking very, very healthy and very consistent, 30% in 2024. Finally, net debt to EBITDA, as we can in fact see here, 0.17 in 2024, 0.15 over the next 12 months. So looking very, very good. Again, this does have globally in line with Johnson & Johnson, one of the best balance sheets, graded very, very high. So in terms of the valuation of Microsoft today, well, our intrinsic value of $445 is still lower than Wall Street's forecast of $505. They deem there to be around 21% upside, which is still very good for a Mag 7 company that has been firing on all cylinders over the longer term. And when we do look at a margin of safety, remember for companies like Microsoft, some people will have a lower MOS level, some people will look to buy this at fair value, or some will just look to dollar cost average over the longer term, which is always a great strategy. So at a 10% MOS, you would have to wait for around $400, something maybe we could see in this month with a lot of volatility expected with interest rate cuts looming. But for those that are willing to buy it at a 5% MOS, that would be up to around $423. Now, for those that just want to know what the MOS would be at 15 and 20%, well, that would be 378. And for those at the 20% mark, would be around 356. As we said in today's episode for Microsoft, 5% MOS with 21% upside. Do give us your thoughts. And if you are someone that does dollar cost average a company, or in fact a bunch of companies over long term, Microsoft is definitely one of those to consider. We then move on to Canadian National Railway, where we have a buy from Seeking Alpha and a double hold. This one trades in the mid to low end of the 52-week range with a yield just over 2% and a forward P of 20.6. Over the last year, well, up around 3%. Over the last 10 years, up around 60%. As we can see, all-time high sitting around $136. But again, over the 52-week period, it hasn't been too far off at the 134. In terms of their earnings, well, their more recent one, they actually missed by around 7 cents. And over the last 4 quarters, we do note a lot of inconsistency, in fact, on a quarter-on-quarter basis. Next quarter, anticipating double-digit growth. And as we can see, over the next 4 as a whole, positive are what is anticipated from the EPS in general. And if they hit their next year full EPS of 6.45, the forward PE will come down to around 18.25. Now, very nice to see a very safe score of 97, as well as a healthy increase just this year at 7%. And do bear in mind, with these type of industries, they are fairly cyclical, so we may see some of that through their numbers. In terms of the last recession, while they increased the dividend, they had average growth, and they also marginally outperformed with the negative 45% recession return. Also, very nice to report, over the last 5 as well as the last 20 years, they have been increasing those dividends at a double-digit rate. And we can, in fact, see they are a dividend aristocrat with more than 25 years of consecutive increases to the dividend. Now, when we get to dividend yield theory, we get a double undervaluation signal, both on yield as well as the forward P, although it isn't too dissimilar from the 5-year of 20.9. But when we do look at the industrials in terms of the sector as a whole, it is pretty much bang in line there with a 19.9. Now let's get to the actual metrics. So for the free cash flow payout, we do notice, even though it has been increasing over the last 10 years, still very healthy at 55% in 23, 63 anticipated over the next 12 months. So not too far off that maximum level that we do want to see in general. And in terms of the free cash flow per share, very inconsistent. It has in fact grown more than double over the last 10 years, but the movement over the last few years has been very, very minimal. In fact, a very few small decreases. And when we look at sales growth, as we said, cyclicality coming through the numbers, 3 of the last 10 years negative, including 2023. But sometimes we do want to look at these companies when they are down, in fact, at the lowest point of their cyclical cycle, and consider now whether or not is a good time to buy. In terms of total sales, well, we can see, in fact, around 40% growth over the last 10 years. And one thing they do very nicely are those share buybacks, in fact, decreasing it from 824 to 645 in 2024. Then we get to the ROIC. Consistency is something we do love, and sometimes it is worth paying a bit of a premium for those companies that continue on a year-on-year, quarter-on-quarter basis, providing some very healthy numbers. That is what we see on the ROIC, around 14% just in that more recent year. And when we get to the margins, again, very nice and very strong in terms of the levels, well above 12%, in fact, in the low 40s consistently, and the free cash flow as well looking very healthy. So no real worries so far with CNI, especially when we do look at their margins. And when we get to their net debt to EBITDA, well, below 3 is what we want to see. That is what we get. And even though the increase is there at 2.2 over the next 12 months, it is still very healthy and sufficient space and headroom below that maximum level. Now, in terms of the valuation of CNI, well, our intrinsic value at 133, not too far off Wall Street at 135. They see 15% upside, and when we do run it through the calculation at a 10%, a buy at 119, not quite at that 15% level yet at 113, but again, if we do see that over the next few weeks, this could be one to consider, especially if you don't have this industry and are looking for companies like this. Another very strong candidate is Union Pacific, UNP, that again, we do believe right now that isn't trading at an undervalued level. And for those that want to see it 20%, as we can see, 106. So in today's episode, sitting somewhere between 10 to 15%, with Wall Street indicating over the next year 15% upside. As always, do give us your thoughts below. We then move on to Fisa. Now, this is one to consider, especially for those that do like high yields. And with those interest rates coming down, we do anticipate a lot of these companies to have a lot of money come in them, moving out of essentially these savings accounts. And we get a double buy signal with a hold from Quant. This one is still trading in the mid to lower end of the 52-week range, with a yield around 5.8% and a forward P of around 11. Over the last year, well, down 19%. Over the last 10 years, up very marginally at 3%. No surprises, it has been coming down from the COVID highs at the back end of 2021 around the $60 mark. Now, very nice to report over the last 4 quarters, another one that has beaten every single one. So that is a 100% track record. And if they do hit next year full annual accounts of 2.86, that forward P will come down to around 10.14. Now, we get a dividend safety score of 75, and we do note a very mediocre increase of 2.4 just in December. Remember, we want to at least be in line with inflation at that 4% level. And when we do look at the recession, how they performed, well, in fact, they cut the dividend, they had above average growth, and they also marginally outperformed the S&P. At least over the last 5 years, as well as the last 20 years, you will be getting an increase in that dividend at a minimum in line with inflation, and they have been increasing those dividends for the last 13 years consecutively. Then when we get to dividend yield theory, we get a strong undervaluation signal on the yield. In terms of the forward PE, it is pretty much around that 5-year rolling of 11.9, but it is substantially lower than healthcare as a sector at 17.1. Now, in terms of free cash flow payout, what we see here now is a red flag indicator, 193. This indicates to us management paid out more in dividends than they generated in free cash flow. Positive to take, though, over the next 12 months, it is anticipated to come down to around 73%. Then we get the free cash flow per share. Now, look, there isn't consistency in these numbers, and we all know that during the COVID period, they had a very good couple of years. It is now down to around 85% in 2023, but over the next 12 months, this is anticipated to increase to 231, and they have been doing some acquisitions that we have covered in some in-depth dives of Fisa as a whole. In terms of their sales growth as well, no surprises. Again, we have covered this in depth, but we do notice COVID was very good for this company, 95% in 2021, 23 in 2022. Before then, it wasn't the greatest, and in fact, in 2023, negative 42%, their top line did really suffer. Then we get to their total sales numerically. As we mentioned, COVID was their best year for them at 100 billion, now sitting around 58.5. And over the longer term, they have done some share buybacks, nearly buying back, in fact, 1 billion in those shares. Then we get to the ROIC, looking very good up until 2023, where it is down to 3%. We want to be keeping a close eye on these numbers. We want it to go back up to the very consistent levels of 10% or more. And no surprises, again, 2023 just not looking good for this company. COVID did impact them, or we should say, in fact, post-COVID, and that is why they have done a lot of acquisitions. One of the more recent ones being the CGen for quite a substantial amount. And we can, in fact, see, in terms of the numbers, 2023 at 9%, trading 12 months at 6% is a little bit of a cause of concern. That is why for some of these, we do like to imply a larger MOS level than others. Free cash flow margin, even though we do notice the drop, and it was looking at very healthy up until 2022, we do still note it is above 5%, and on the trailing 12-month basis, sitting at the 9% point. Net debt to EBITDA as well, below 3 is what we want, 3.75 in 2023. It is higher. However, over the next 12 months, again, something we should corroborate when we do get their quarterly report, aiming to be around 2.69. Now, when we talk about Fisa in terms of their yield, looking very good, but how about the valuation? Well, our intrinsic value, 34.86, marginally higher than Wall Street, 33.83, where they see 17% upside. And when we do run it through the MOS, well, at 10%, a buy at 31.37, at 15%, around 29.63. So up to around the $29-30 mark, you are getting a 15% MOS. Wall Street are indicating around 17% upside. And as we saw, this yield is just below that 6% point, which could look very, very good in a couple of years' time when interest rates do come down. We then move on to Qualcomm, the semiconductor company, with a double buy and a hold from Quant. This one trades in the midpoint of the 52-week range with a yield just under the 2% point and a forward P sitting around 17.5. Now, over the last year, it is up around 55%, although we do note a pullback from the $230 52-week high. And over the last 10 years, this one has outperformed the S&P, although marginally at 131%. Also, love to talk about these companies that do beat on a consistent basis, Qualcomm being one of them, 100% track record. Next quarter, double-digit growth, and over the subsequent three, positive, which is always great to see. Forward P anticipated over the next year, full annual report, 15.6. Also, great to see a dividend safety score of 80 safe, as well as an above inflation increase just this year of 6.3%. Then when we talk about this in terms of the last recession, while they increased the dividend, they had above average growth and they did outperform the S&P quite substantially with a negative 21% recession return. And as we said, an above inflation increase this year, above inflation over the last 5 years, and actually very strong over the last 20 at 20%, something we would like to see them bring back moving forward. We also note 20 years of consecutive increases, so they are 5 years away from becoming a dividend aristocrat. We then talk about dividend yield theory. Now, we do get a marginal overvaluation signal on the yield, and in terms of the forward P, that does sit in line, 16.4 versus the 16.2. When we talk about the information technology sector as a whole, though, Qualcomm does sit much lower at 16.4 versus 24.2. Then we talk about the free cash flow payout. Now, below 60% is what we want to see. 50, though, for semiconductor specific industry. That is what we get over the last few years, and 31% over the next 12 months does indicate to us that hopefully we will see a better increase to the dividend than the small above inflation increase that we saw this year. In terms of free cash flow payout, again, very important to note with this company, similar to previous companies that we have discussed today, this is fairly cyclical as an industry overall, but they have nearly doubled their free cash flow per share, 458 to 882 in 2023, and anticipated to continue to 1080 in 2024. Then we look at the sales growth. As we said, it is cyclical, so no surprises. 5 of the last 10 years have been negative growth, including 2023. And when we do zoom out, we can clearly see this in the numbers, 26.5 billion to 36. But very nice to report, they have been buying shares quite significantly over the last 10 years. But again, whilst it does look very large, it is very inconsistent. So there is no general theme that we can spot in terms of when they do like to do this. ROIC, though, looking very good, well above the 12% for this industry, 23 in 2023, expected to increase based on the trailing 12 month as well at that 25 percentage point. Then we get to the margins, well above 16% in terms of the operating side. We do want to see operating efficiency, not something we do get, again, fairly inconsistent. But in terms of the free cash flow margin, looking very good, above 5% on a year-on-year basis. 34, in fact, the highest it has been over the last 10 years is what we see on a trailing 12 month. Then we get to the final metric, net debt to EBITDA, one of the best for this company, below 1.5 for semiconductors, 0.35 in 2023, 0.1 expected over the next 12 months. So very good in terms of the dividend safety as well as that secure balance sheet. Now let's get into the intrinsic value. Now we get a price here of $210. What we do note though, Wall Street do see this higher at 221. They have upside of 26%. And when we do run it through the MOS, well, at 10%, a buy at 189, at 15% around 178. So right now, for what we would deem to be one of the highest quality semiconductor companies, you are getting at least a 15% MOS, with Wall Street indicating 26% upside at the 221 point. Now the 20% point, for those that are interested, you would have to wait for around 167, 168, something again we could see over the next few weeks. As always though, we will conclude and say 15% is what you're getting with the 26% upside, but do give us your thoughts about each one of these 6 below, whether you're adding maybe on the watch list or for whatever reason these aren't companies you're interested in. As always though, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to subscribe to that free weekly newsletter. We do drop one every single Monday, and also come and join us in the Patreon if you do want to discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.